Welcome to the Financial Fitness webinar series, where we are going to talk all things financial fitness. Today, we're kicking off with our functional fitness. Come back for our financial fitness webinar, as well as our financial performance webinar that will follow these. So let's dive in. We're talking about functional finance. So what do we mean by functional? Well, think about what this means when you're working with a client on functional fitness. This is your foundation. So this is going to be everything that your finances are built off of, a base, right? So it's going to support you as you move forward in your business. What these tips that we're going to share with you today, the foundations of building your financials and getting the information that you need to move forward, just like working with your clients on building the base fitness and every day. So functional fitness allows you or your clients to live an everyday life. So functional finance is going to allow you to process your transactions on an everyday basis, just kind of your finances on an everyday basis. That's what we're talking about today. The word accounting, so we're going to be talking about a lot of accounting. The word accounting comes from the word accountability. If you are going to be rich, you need to be accountable for your money. And what we're going to talk about today is going to help you be accountable to yourself or be accountable with someone else. So what are the foundations and functions that you need for accountability? Well, in order to have that, the first thing you need, and we're going to go more in depth on each of these, is a business bank account, a business credit card, a tracking method for tracking your finances, a routine process, because you can have a software, but if you're not using it, then it doesn't do you any good. So a routine process for completing your accounting and for reviewing your finances. And the last thing, an accountability partner, right? How much more successful are your clients when they have a coach or some kind of accountability to keep them on track? You need the same thing in your business. So who is your accountable partner? Are you part of a group? We'll get into that some more. So let's dive in. A business bank account. Yes, you need to separate your personal finances and your business finances. And when we get to one of the other steps on tracking, it's going to make that a lot easier if you have your own business bank account. Here in the Midwest, we have really good relationships. We have very good banking relationships. So I would say find someone that you know in your network that works for a bank and open a bank account. If your bank that you bank with personally has business bank accounts and you like that bank, then go open a separate business bank account. There generally is a small fee associated with that. I think mine is like $6.95. But having those separate accounts is very important, especially when we get to tracking your business finances, because you don't want to have to continue to separate them out manually, your personal versus your business finances. I'll tell you one thing too, with the PPP loan that came out, they required you to actually move money from your account to show that you were paying yourself in order to satisfy their payroll requirements. And if you didn't have somewhere to, right? So like there's just multiple reasons that you should have a separate business bank account from your personal bank account. The second thing, a business credit card. Now, if you get in trouble with credit cards, this might not be one of the steps that you want to take. You might just want to get a bill pay option that's connected to your accounting software, which we can get into later. But you definitely want to have some way to be able to pay bills on a recurring basis, subscriptions that your business has, but you want it to be a business card and not a personal card, because again, you're going to be manually separating out those personal transactions from your business transactions. One that I found was really easy. You just go online, is the Capital One Spark card. It's very easy to complete the information, and if you qualify, then you'll get a card. The big thing though is just make it a business card. The third thing, tracking financials. So how are you going to know how your business is doing if you're not able to track the numbers? And it's so important that you have number 1 and 2 taken care of before you start this, so that you know what your business money is versus your personal money, so you can track your business finances. There are several ways that you can do this that we're going to get into. You can simply use Excel. If you have like a Microsoft 365 or Google Sheets, right? So if you have a Google or a G Suite subscription or a Microsoft subscription, you're already paying for that. And you can certainly keep it in a Google Sheet or in Excel if you don't have a lot of volume and if you keep it up, right? So just think about what can you maintain, because Excel is a manual process, which means you're going to have to go in and you're going to have to enter all of the transactions. You're going to have to create some kind of system to calculate your cash income and your expenses to know how profitable you are, so you can really understand what's happening in your business. So this is part of building the foundations, because if you're if you have a goal of, if one of your clients has a goal of weight loss, but you're not weighing, then how do you know how they're tracking to their goal? So this is the same thing. If you have business goals, it all comes back to the numbers in your business, and you can't run a business if it's not profitable. So how are you going to know that? Tracking your finances for your business is very important, and it's important that you keep up with it, which we'll get to later. So you can use a Google Sheet, you can use Excel, but think about what can you really maintain? Like, is it dreadful to have to go in and update that manually all the time? Because it is manual. And do you know enough about Excel or Google Sheet to create the formulas that's going to calculate how profitable you are? And even go further when we get into our other webinars in this series and talking about your goals and different KPIs to track, which are key performance indicators, just different metrics that you can track that is going to help you know how well you're doing in your business. Just like you might track BMI for a client, there's specific KPIs that you can track for your business based on your goals. And it all comes from having these foundations set up. So really this functional finance, and this is a big one, is tracking your financials. So you can certainly use Excel or a Google Sheet. It's free, right? There's no additional cost if you already have a Google account or Microsoft. But you do have to create your own formulas. That's a downfall, and it is manual entry. You certainly could scan in receipts and probably store them in your files on your computer or in the cloud, but it's kind of a second step. There's definitely better options if you're looking to streamline this process. But if you want the cheapest option, this totally is your cheapest option, but it may take up more of your time. So if you're looking to save time, what would be my recommendation? So I have two recommendations: using QuickBooks Online or Xero, and we're going to talk about each one of these. So if you're using QuickBooks Online, the subscription cost for the self-employed, which is probably what most just small gym owners need if you're by yourself. Once you grow, you might look into their higher level subscriptions, but you probably don't need those. So the self-employed is $15 per month. That's your cheapest option. It does have a function called receipt capture. So you will get an app on your phone, and you open the app and you take a picture of your receipt, and it starts to create the transaction from reading that receipt, which is really cool. There, it eliminates the manual entry into some separate file. And then you have electronic storage of your receipt, and you don't need to keep the receipt anymore as long as you continue to maintain your QuickBooks Online account and have access to all of that information within QuickBooks Online. The other good thing about using QuickBooks Online or Xero is the reports function. So you're not having to create formulas to calculate your profitability. It has that built into it already. So it's just a matter of going to run reports and run different financial statements. And we are going to talk about financial statements later. So your other option, then we talked about QuickBooks Online. There is so much help online. If you just search online whatever it is you're looking for to do within QuickBooks Online, there's a lot of YouTube videos that will help you if you're trying to accomplish something within the application. The other option that you have is Xero. It is $12 a month, and it, instead of calling it receipt capture, it uses a functionality called HubDoc, which does the same thing. It reads your receipt, creates the transaction, you're going to have to go in on both QuickBooks Online and Xero and review what it has created and make sure it's getting coded correctly, it's the right amount, the right vendor, that kind of thing. So there is some review that you need to do, but it takes out one step from the process, separate from what you would have to be entering into G Suite or Excel. So those are your options. There's definitely a ton of other options, but these are the most popular. Now we get into a routine process. So just like your clients are going to be more successful if they schedule their workout or they schedule what their menu planning is for the week, right? Like they're prepared for the week and it's consistent. You need a consistent process for going in and maintaining your financial records. For us, and what I actually would recommend is on a monthly basis. So a lot of small business owners might create some CEO time on their calendar where you're just focused on the business, and this could be part of that, is on a weekly basis, whether that's a Friday or a Sunday night. You go in and it's a lot easier. I'm going to tell you if you're using QuickBooks Online or Xero, where those transactions are just automatically feeding into your account, or you've snapped all your receipts for the week and then you just have to go review them rather than going into a G sheet or an Excel file and having to manually enter them. A lot of times that is what holds people back. So whatever is going to get you to do it, do that routinely, right? And consistently, just like you want your clients to be consistent and that's going to help them build a base and build a foundation. You need to be consistent in tracking the financials for your business as well. I would say on a weekly basis, go in and pull your banking activity if you're using an Excel sheet or a Google sheet. QuickBooks Online and Xero can both connect to your bank account and pull in that data. You also, though, want to be taking pictures of those receipts, and they'll generate those transactions, review your receipt transactions, code them all out, and then it's just a matter of matching information up within the accounting application. Again, we're not going to get into how to use different applications here. There's all kinds of help online if you just search. Or what is good is there are bookkeepers and accountants that are certified with Xero and certified with QuickBooks Online. So you can find certified you can find those individuals online with a search. So who knows Xero and who knows QuickBooks Online if you need help in that area. But we're talking about a routine process. So, whether that's every Friday, at least monthly, because in this process, one thing you want to do is what's called a bank reconciliation. And that might be where you need help from a bookkeeper. But again, there's all kinds of help online. As part of our next webinar series talking about financial fitness, we're going to get into some more depth into that. But you would just need your bank statement. It's going to have your beginning balance. It's going to add in transactions coming into your account for the month, subtracting out expenses paid from your account for the month, and then it has your ending balance, and you're just reconciling that activity to what's in your accounting application already so that you're confident in the information that you're working with. So again, we're just building this foundation to help you be better in your business. A lot of it comes back to your finances. And so having this process down on a weekly basis of going in and looking at your transactions, and then on a monthly basis, reconciling the bank is very foundational in getting you where you want to go in your business. So establish that routine process. An accountability partner. So then I was also going to say, if you have an accountability partner where you're somebody that's just making sure you're actually doing it, maybe it's your bookkeeper or accountant that is relying on you to go categorize transactions, which means you're indicating if it was revenue, if it was an expense, what type of an expense, and that kind of thing. Maybe that's your accountability partner, just somebody that's counting on you to get this done. And maybe it's a group, maybe it's a coach or it's a group that you're part of that you need that accountability saying, okay, have you done this? and making sure it's on your list to get done weekly, monthly, that kind of thing. So making sure you have an accountability partner. And maybe that is like a project software too. So I use Asana to track all of the tasks associated with a different project or assignment that I'm working on. And so that could be your accountability also if Mindbody has tasks within Mindbody. So even if it needs to be a Mindbody task that's assigned to you, to make sure you're looking at this every week and every month, maybe that's the accountability that you need. If so it really depends on what is it that you need to be accountable to make sure you're looking at this routinely and talking about it as well. All right, so once we're tracking our information and you're reconciling your bank account on a monthly basis, you can run reports in QuickBooks Online and Xero, and you'll get financial statements. So they have an income statement, a balance sheet, and a cash flow. If you're using Excel, you're going to have to build the functionality with formulas within Excel to get this to you. And so that's why I think it's good to be in an accounting application so that you can get this information. And we'll go over later what to look for. So I'm going to help you with all of that. So the three financial statements. And if you're working with a bank, they may ask you for these statements as well. So it's good to be in an accounting application where you can just easily run these reports. And I did just have a client who has investors tell me how great it was just to have the updated bookkeeping because his investors wanted financials and he just had to go into Xero and run the report. So it was super easy for him because we're in a routine process of keeping the information up to date. I'm in there every week. I reconcile every month. And so it's super easy. The other thing I'll tell you too is we've been working with a GEM and we actually do financial forecasting for them. We do their bookkeeping, reconciliations, and financial forecasting. They went to the bank to get an SBA loan, and because we were working together, we already had all of the information that they needed. It was just a matter of running the reports. So it is so important to have this good foundation of functional finance to be able to really do anything in your business and know where you are. So the three statements a lot of times that banks ask for or investors are going to ask for is your income, your balance sheet, your income statement, and your cash flow. And so we're going to talk about each one of these statements so you understand what they are. And then we're actually going to go look at some and I'm going to help you with some analytics and what to look for. So the first one, the balance sheet. So what is a balance sheet? So this shows what you own less what you owe, which equals your net ownership. And it's called different things on the balance sheet, and we'll look at that together. And this is at a specific point in time. So this could be as of the end of last year. It could be as of today. It could be as of the end of last month. And you can, if you're in an accounting application, you can run the reports for any specific date that you want, but it's going to be as of a specific point in time. On the balance sheet, you have what's called assets. So that's what you own. And these are things like the cash in your bank accounts, accounts receivable. So if you build members, but you haven't received the cash yet, that's an accounts receivable. So you're going to be receiving that money. That's an asset that you own. If you have inventory, so if you sell supplements or you sell apparel, those kinds of things, and you've purchased those items before they've been sold, that's inventory that you have and you own that. And so that's an asset for your business. And then another huge one for a lot of GEMs is fixed assets, which are like equipment for the most part for GEMs. This could also be buildings if you own your building. It could be improvements that you've made in a building that you lease. That could be leasehold improvements. So that's fixed assets and you own that. But the biggest one for most GEMs is the equipment that you buy. So then from there, so that's what you own. There's some other things, but these are the main ones for GEMs. Then it's what you owe. So do you have, so it's vendors. So this would be paying vendors for your supplements or your apparel, or paying vendors for cleaning supplies, different things that you're purchasing for your gym. So that's, you have accounts payable. So who do you owe money to for kind of those everyday operational things where you've purchased the item, maybe received an invoice for that, but you haven't yet paid it? That's an accounts payable. So who do you owe money to as far as a vendor goes? employees. So you might have, you probably don't track accrued payroll, but you have employees that have worked for you for a period of time that you haven't paid yet. And so you owe your employees for those wages that they have earned and working for you that you haven't paid yet. So that's a liability for your business. And then I say creditors, which this would mostly be like banks or leasing companies. And this would generally be, loans that you've received to open your business, to run your business, to purchase equipment, that kind of thing. That is all what you owe. And then when you take what you own and you subtract what you owe, that's your equity in your business. And so that could be what's called net assets, because you're taking your assets minus your liabilities equals your net assets. So this is what's left after you subtract what you owe from what you own. And so you really want that to be positive. If that's negative, then you've probably been operating your business at a loss. Potentially you're in the startup phase, and hopefully you have projections that are going to get you to the positive side of things. All right, so then the next one is an income statement. So an income statement shows you what you've earned less expenses related to operating your business, and that equals your net profit. And this is for a period of time. So this could be for a month, or you might be looking at it for a month, and you might look at this month compared to last month. You might look at this for the year, right? For last year, right? So when you do your income taxes, you're looking at that for a full year, and that's what goes on your income tax return and what you pay taxes on. So this is for a period of time. Again, if you're using an accounting application like QuickBooks Online and Xero, it's super easy to run these reports. You just toggle on your dates that you want to see and review information for, and it's super easy to see. So an income statement shows your revenue, what you received in from your services or products that you've sold, less the expenses that you've incurred in order to run your business, and that equals your net profit. So what is revenue? So revenue is what you've earned for the services and the products that you sell. So this could be membership fees, product sales, personal training, that kind of thing. So money into your business, what you've actually earned, you've provided the product and service, and so you've earned that revenue, goes on your income statement. Expenses, so these are costs to do business. So this could be your product purchases for the product that you sold, salaries and wages, rent and utilities, advertising, insurance, and the list goes on. So all of your costs to do business. There is something that's called gross margin, which is your earned revenue less your direct cost. So your direct cost you might hear this be called cost of sales, cost of goods sold. So direct costs are what goes directly into providing the revenue, selling the product, providing the service. And so these are things like wages. So a lot of these could be your trainer wages, your coach wages, your group X wages, because that's directly related to providing the service. This could be purchases of products that you sold, because that's directly related to the product that you're selling. So what is directly related to that? Then you have, so it takes your earned revenue minus those direct costs is your gross margin. So you might hear people talk about gross profit. I guess that's really your gross profit. Your gross margin percentage we'll get to later. Then there's what's called selling, general, and administrative. So these are your indirect costs. So it's not specifically directly related to providing the service or selling the product, but they are part of running your business. So this is more overhead type items. So this could be like the service desk attendants, who's working the service desk. They are interacting with your members, but they're not providing a direct service. And then the other could be potentially like sales, right? Selling, related to selling, not related to actually providing the service and products. The other thing, overhead, is just utilities and rent and insurance and those types of things that you can't directly tie to providing the service they're selling the product. The third statement is a cash flow statement. So a lot of times you're probably going to be keeping your financial statements on what they call a cash basis. So anytime you get money in, you're going to be recording that. And anytime you spend money, you're going to be recording that rather than having like unearned revenue or prepaids or accrued expenses. But so a lot of your items are going to be on a cash basis. But they have what's called a cash flow statement. So this is going to track all the cash received and spent for a period of time. Whether that's actually on your income statement or on your balance sheet, it tracks everything. And it groups this activity into 3 separate categories. And so one of those categories is operating. So this relates to you actually operating your business. What is needed in direct operations of your business? And it tracks that cash received and cash spent for operating activities. So a lot of times this is your revenue and your expenses on your income statement. Then they have what's called investing. So this is what's received or spent for investing activities. And so the most likely one would be purchasing your fixed assets. So purchasing your equipment, you're investing in your business, and that is going to your fixed assets go to your balance sheet. And so this, or if you sell equipment, like that cash that you get is going to go into this section. That's investing activity. So that's not something that's happening every day in your business. Purchasing equipment doesn't happen every day in your business. That's more of you investing in your business. And so that is going to be in the investing section of your cash flow. The next one is financing. So this is cash in or cash out related to financing activities. So this would be for loans or money that you put into the business or take out of the business, because again, this isn't in the operating section of the cash flow statement because it's not related to operating your business on an everyday basis. Yes, you need that loan to buy the equipment to have your business to operate, but it's not part of your everyday operations. And so that's considered a financing activity. So let's look at these together. We're going to look at financial statements. And when we look at these, there's some things I'm going to be going over. I'm going to point out just some high level things on these financial statements as we look at them. And then I'm also going to show you what my analytical mind looks for, because these financials should be telling you the story of what's happening in your business. And if you're operating your business and you're in it every day, you're going, well, hopefully you feel what is happening and that these financial statements then validate that. And hopefully you're not too much into operating your business that you don't really see what's happening. But if you are, and that is happening, then these financials are going to tell you the story of your business and bring things to light that maybe you didn't know. And even if you have a good feel, this might point out some things that are happening in your business that you didn't realize. So let me share these financial statements. And they are in Excel, which is not the most friendly thing to look at. But as we're talking about financial statements, I think it's important for you to actually see them and what they look like. I know a lot of times business owners, if this is not their expertise, it's very difficult to look at these, but I'm really hoping I can help you better understand how to look at financial statements. So what we have, the balance sheet is made up of assets, liabilities, and equity. So our assets is what we own. So we said that's cash, inventory, and fixed assets. And sometimes you have what's called other assets, but those are the main ones. So you can see here how it's shown. Then liabilities are what you owe, right? So what you owe vendors would be accounts payable. What you owe employees would be on here as an accrual if you're keeping that. A lot of times you're not going to be because you're on a cash basis, and that's totally fine. But that is still a liability for your business because you do owe those employees for the time that they have worked in your business that you have not yet paid them for. And then long-term debt, that's really your creditors, right? So those are your loans that you've gotten from the bank or from a leasing company. And then you have the equity section here. So this is going to show you any investments that you've put, any cash you've invested into the business, any cash you've taken out, it is going to be shown here. So, and the balance sheet does balance. So you take your assets here. So your total assets equal the total of your liabilities and equity. So when you're looking at a balance sheet, those will match. So let's just continue to go over these financial statements and review kind of what we already said and looking at an actual financial statement. And then we're going to come back and we're going to kind of analyze the information that's in here, and I can show you some things to look for. On the income statement, you might also hear it referred to as a profit and loss statement, a P&L, but it's going to have your revenue. It's going to have your cost of sales. So this is your direct cost. This could also be cost of goods sold if you're selling goods. A lot of times, right, like a company that's selling goods, it's going to be cost of goods sold, like manufacturing or retail. In this case, you're selling a service, so it's cost of sales. And then here's your gross profit. We talked about that, which is your revenue minus your cost of sales. And then you have a gross margin. I called it gross margin, but here's a gross margin percentage, and we'll talk about that a little bit later. And then this expenses section is those selling, general, administrative expenses that are not directly associated with providing your service or product, but they are required expenses to operate, like advertising, insurance, rent, utilities, that kind of thing. And then sometimes there's some other items in here like interest income, interest expenses, maybe different taxes and licenses that you're going to be paying. Sometimes depreciation and amortization are in here. And then that gets you to your net income or your net profit. And then on a cash flow statement. So we said this is broke out into 3 different categories: your operating, your investing, and your financing. And if you're keeping everything on a cash basis, you don't have any accounts receivable or accounts payable, then you really are just going to have net income is your cash operating activities. Investing activities, again, this is right like your fixed assets here. Whatever you purchased or sold is going to show up here. And then financing would be any debt that you took on or that you paid. So if you're paying off your loan, that cash out is going to be categorized within your financing activity. If you received any loans within the period, it's going to be a positive number in here. And then it just kind of reconciles your beginning cash with your cash activity to equal your ending cash, which always equals the cash that you have on your balance sheet in the bank. Okay, so we kind of went through that pretty quickly, but we're going to go back through each one of these and talk about what's happening within them. And so again, you run these out of your accounting application and then look at them with an accountability partner, look at them yourself. Does this make sense? So that's what you should be asking yourself as you're looking at this. So I am just looking at this in year over year. So at the end of December, so this particular business was impacted by the pandemic, so their cash balance got pretty low within that pandemic period. And then we projected that they're recovering from that period. So you can see their cash went from about $350,000 to $600,000 projection at the end of December, which is a pretty big increase. And that's really driven by their membership coming back. Now, if membership doesn't come back, they probably won't hit those cash balances. But just, understanding what's driving the change in these numbers. So you're going to know your business, you know your operations, you know what's happening, you know what you expect to happen in your business. So are these numbers reflective of that? And are they telling the same story that you're telling yourself or that you know is happening within the gym? Because this really should go along with what is actually happening. Inventory, that we projected that to stay the same, but if you were investing more in inventory items based on projected growth, then that number may go up. Cost of items, if the cost of whatever your inventory items are is going up, then potentially that number may be going up. If you're low on inventory, you would expect this to be a lower number. So a lot of times, if you're looking at this at the end of every month, you're going to be looking at last month compared to this month, which is a much shorter period of time than looking at it annually as we are now. But you'll know, right? So if you had purchased a bunch of inventory last month and you sold through a lot of that and you hadn't yet purchased any more, your inventory level is going to be lower. So is that really what you're seeing happening in your gym, that you really don't have a lot of inventory? We better purchase some more inventory if you didn't realize that, or that's not in line with what's actually happening in your business, then stopping and asking the questions like, oh my gosh, what the heck is going on? All right, so then fixed assets. So this is your equipment. So you're going, when you purchase equipment, this number is going to go up. If you sell some equipment and get rid of the equipment, then this number is going to go down. Your same thing, you probably are not going to be tracking your vendor payables or your accrued payroll. But if you are, you probably know what's happening there. And then if you do have debt, if you have loans, you really do need to be tracking those on the balance sheet. So then as you pay those off, those balances are going to be decreasing. All right, on the income statement, the P&L, the profit and loss. So your revenue is tracking, right? Like what are you selling? Your services and your products. So this is your personal training income. And so what's happening there? And there's not a lot of variation in these financials here, but you know, so they're pretty consistent from the year 22 to 23. If you saw variations in any of these numbers, understanding why. So maybe last month, like maybe your supplement sales weren't very high. That's what you should be expecting when you look at this month to the last month type thing. Then you have your cost of sales, right? So this is your payroll for your teachers and your coaches and your trainers. Is probably mostly what your direct cost of sales are going to be. And then you're going to have some advertising and some fees, some insurance, those kinds of things. And as you look at these, what is happening from last month to this month or last year to this year, if you're looking at that on an annual basis. Some other things to look at are some percentages here, like gross margin percentage. So gross margin percentage for this particular business year over year is pretty consistent. Even and dollars wise and percentage wise. So what would happen if we would change some of these numbers? Maybe the membership dues go up, but none of our expenses change. I've got to change my formula. This is why Excel isn't good, right? So I changed the number. Okay, so now our revenue went way up. Our expenses stayed the same. I kept those the same. Oh, I'm gonna have to change this formula because it's revenue minus cost of sales, right? So that's our gross profit is now quite a bit more, and so is our gross margin percentage. But let's say with the increased revenue, we also increase the payroll in order to service the revenue. And that actually increased by a greater amount than what the revenue did, then our gross margin percentage is going to go down as well as our gross profit. And sometimes you might see where gross profit might be higher, but we won't get it. But I mean, those are just the things that you need to be looking at. What's happening here? The other big one to look at too is maybe even expenses as a percentage of revenue, because this is going to tell you like how efficiently you're running your business, because your expenses dollar wise could be less, but as your revenue grows, your percentage might be higher. And that may not be the best thing as it is here, right? So revenue went up. Our total expenses went up also, which is okay, but it went up at a greater percentage than we had before. So we are potentially, we might be less profitable. Let's see, when I got to redo this formula. We're going to take our gross profit minus our expenses, which is going to equal operating profit minus these other things here. And then, oh, look, we're actually at a loss. We increased, our gross profit is so far down with the increase in expenses as a percentage of revenue that we're actually at a loss. That's interesting. So it's right, like it's those things. How much is our gross profit? So this is what I'm looking at, like when I'm looking at numbers and analyzing them. So our gross profit is down 190,000. Our total expenses are 150,000 more. And so our operating our net income is, this isn't, our operating profit is probably negative. Yeah, look, our gross profit was 930, but then we have $950,000 of expenses. We're negative. Ooh, right? Like we don't want to be in that position. So what's happening in the business? Like what did we change? We changed this. So we hired and paid more in salaries than what our revenue increased by, and that put us in jeopardy. That wasn't good. So make sure that you plan accordingly and you know what's happening. It's like, oh no, that's why you also want to be looking at this on a monthly basis, have a routine process, because yeah, like, you know, hey, we're killing it in membership signups. Our memberships are way up. We need to hire to accommodate that. Then you hire too much, or you pay more salaries or wage per hour, like your compensation structure is a lot more than what your increased revenue can support. And so if you're not looking at that on a monthly basis to identify that that's happening, because things are probably feeling really good for you in your business. Like, oh yeah, things are great. We've got so many more people in here. Yeah, we've had to hire people or pay more hours in order to keep up. Like that might feel really good to you and like you're doing a lot, but in the end, you're losing money. And so by having a routine process to look at this, identify that, you're able to react to that a lot faster. I would say the better thing to do is to actually project, like before you actually make a change in your business, project what that is for you and what the requirements are. So you can implement that plan accordingly and make sure you remain profitable through that growth, because that's really important. So I hope that helped identify like what to look for with some movements and changes, different increases and decreases from month to month or year to year, looking at some of the percentages like the gross margin, your expenses as a percentage of revenue, and then looking at just some unusual items. So like that net profit or that net loss was unusual, especially given the growth that your gym had. Like, how could you be losing money if you've had all this growth in your gym? That's unusual, right? So that's different. That's something that you didn't feel was happening, but by looking at the financials and having a routine process to do so helped you identify, wait, things aren't as good as I thought they were. And it could be the other way too. So functional this is the basics to build on to get you where you want to go. So just like you help your members build functional fitness so that they can live a good everyday life, maybe they can go on that hike with their grandkids, building this functional finance gets you the basics to build on where you want to go. So come back for us to this webinar series. We're going to be talking about financial fitness and financial performance.